The United States needs to borrow $10 trillion in the next 12 months. $10 trillion. And last week, for the first time in over 3 years, the buyers did not show up. Let that land for a second. The country that prints the world's reserve currency, the country that has never once had trouble selling its debt to anyone, anywhere, at any time in modern history, went to the market last week and the market said no. Not enough. We want more. Because lending money to the United States government right now feels riskier than it used to. And when the people who fund this entire country start feeling that way, everything changes. The interest rate on your mortgage changes. The federal budget changes. The ability of this government to pay its own bills changes. All of it flows from that one moment when the buyers looked at $69 billion in U.S. debt and decided the price was not right. That is not a Wall Street story. That is not a story for economists. That is the story of what happens to you when the financial foundation this country runs on starts to crack. And right now it is cracking, quietly, without any headlines, exactly the way these things always start. This is part 2 of our bond market series. Part 1 is in the description. Watch it after this. Right now I want to walk you through exactly what happened, why it happened, and what it means for everyone who lives inside this economy. The global financial system has started flashing a signal. Not the kind of signal that breaks into your news feed. Not an alert that trends on social media. This is a quiet signal. A technical signal. The kind that gets completely overlooked by most people. But here is what you need to know about quiet signals in finance. They are often the most important ones. Because by the time a financial problem becomes loud, by the time it is everywhere in the headlines, the damage is already well underway. The people who saw the quiet signal early are already positioned. Everyone else is scrambling. So what is the signal? The United States just experienced its weakest Treasury auction in over 3 years. I know what that sounds like. It sounds like the kind of thing you scroll past. It sounds like a boring, niche development that has nothing to do with your daily life. I am telling you right now, it has everything to do with your daily life. And by the end of this video, you will understand exactly why. Let us build this from the ground up, because the foundation matters here. In very simple terms, the United States government spends more money than it collects in taxes every single year. To cover that gap, it has to borrow. The way it borrows is by issuing Treasury securities, bonds, notes, bills. It puts those instruments up for sale at what are called Treasury auctions, and investors from all over the world show up to buy them. We are talking central banks of other countries, major commercial banks, pension funds managing retirement savings, sovereign wealth funds, hedge funds. All of them participate. In exchange for lending their money to the U.S. government, they earn interest. That interest rate is what we call the yield. Now, for a very long time, this system worked beautifully for the United States. Global demand for U.S. Treasuries was so strong, so consistent, that the U.S. could borrow at low cost. Investors trusted the U.S. government completely. The Treasury was, without question, the safest asset on the planet. The thinking was simple. No matter what happens in the world, the United States will honor its debt. You will get your money back. And so investors lined up. Governments parked their reserves in U.S. Treasuries. Pension funds loaded up on them. Central banks held them as their primary reserve asset. Well, that time is gone. That confidence, that absolute, unquestioned faith in the U.S. financial system and its institutions is eroding. And it is eroding fast. Global investors are losing their trust in the United States. And when trust goes, demand goes with it. When demand goes, the only way to attract buyers back is to offer higher yields. Higher returns in exchange for the growing risk. But here is the trap. The higher yields go, the more interest the United States has to pay on its debt. And the more interest it pays, the more it has to borrow to cover those payments. And the more it borrows, the more supply hits the market. And the more supply hits the market with weakening demand, the higher yields have to go to clear it. This is a vicious cycle, and it is already in motion. Now, to really understand what this means for the full $30 trillion US bond market, I want you to watch the first video in this series. Link is in the description below. Watch it right after this one. But right now, let me walk you through exactly what just happened and why it matters so much. Last week, the United States Treasury went to the market to sell $69 billion in 2-year notes. That is an enormous dollar amount, but in the context of U.S. debt markets, 2-year auctions are routine. They happen regularly. They are considered the boring end of the Treasury market. Two-year notes are short duration. Investors are not locking money away for a decade. The risk is lower. The inflation exposure is lower. And historically, demand at these auctions is very strong, very reliable. They process without drama. Yields stay stable. Nobody writes a story about them. This time was very different. Demand came in weaker than expected. Investors were not showing up aggressively. They were not bidding at the levels the Treasury was counting on. And when that happens, when supply exceeds the appetite of buyers, the price of the bonds falls. And when bond prices fall, yields rise. That is just arithmetic. By the time this auction cleared, two-year yields had been pushed up to around 3.9%. At the exact same time, yields on 10-year and 30-year Treasuries were also climbing sharply. Across the entire yield curve, from short end to long end, investors were demanding more compensation, more return for the risk they were being asked to take. And here's the part that I really need you to sit with. The Federal Reserve has not raised interest rates. The Fed has not moved. There has been no policy change. These yield increases are coming entirely from the market itself. Investors are independently deciding that U.S. government debt carries more risk than it used to, and they are pricing that risk accordingly, without being told to, without a central bank instruction, on their own. Under normal circumstances, that does not happen. U.S. Treasuries are supposed to be the safe haven. When the world gets nervous, money is supposed to flow into U.S. debt, not out of it. The fact that we are seeing the opposite, that investors are pulling back and demanding higher compensation precisely when global uncertainty is rising, tells you something fundamental has shifted. Now let us talk about what is actually behind this. Because numbers do not move in a vacuum. Something is driving investor behavior. And right now, much of this shift, I would say the majority of it, can be traced back to what is happening in the Middle East. Since late February, following the attack on Iran by the United States and Israel, oil prices have surged. Not a small move, not a blip. We are talking more than 40%. More than 40% in crude oil prices since late February. And a critical factor in that move, the factor that makes this more than a temporary spike, is Iran's influence over the Strait of Hormuz. That is the narrow passage between the Persian Gulf and the Gulf of Oman, one of the most critical energy corridors on the entire planet. Roughly 1/5 of global oil supply moves through that strait on any given day. If Iran moves to close it, even partially, the disruption to global energy supply would be severe. At the same time, the Ansar Allah movement in Yemen, which has very significant influence over the Bab al-Mandab Strait in the Red Sea, represents a second major choke point under pressure. That strait is the gateway between the Red Sea and the Gulf of Aden, another critical corridor for global energy and trade. Both of these passages are now under active geopolitical threat simultaneously. That is not a coincidence. That is the structural reality of where this conflict has placed the global energy system. And the result of that is crude oil above $100 per barrel, with, I would argue, a real possibility that it goes higher. Much higher. If this conflict continues on the trajectory it is on. Now here is what rising energy costs do to the broader economy, and specifically to the bond market. Because this is how everything is connected. Rising energy costs are now feeding directly into inflation expectations. And inflation expectations are what drive yields. Here is a key thing to understand about interest rates. When the Treasury auctions securities, it does not set the yield. The market does. It does not set the yield. The market does. Investors, including major banks and institutional money managers, they assess duration risk. They assess inflation risk. They assess liquidity needs and opportunity costs. And then they bid based on their assessment. If they believe the yield being offered is too low relative to those risks, they simply do not bid. Or they bid less aggressively. And that forces the yield up until it reaches a level where enough buyers are satisfied. And that is precisely what happened at last week's auction. Inflation uncertainty made investors skeptical, made them very, very uneasy. They looked at energy prices climbing above $100 per barrel, and they thought, if inflation runs higher than expected over the next 2 years, a bond yielding 3.9% is not going to cut it. And so they pulled back. They demanded more, and the market gave it to them. As inflation concerns grow like this, investors do not just change one bid. They change their entire posture. They are pulling back from longer-term bonds. They are shortening their investment horizons. They are moving to shorter maturities where they are exposed for less time. They are waiting for more clarity before making long-duration commitments. This behavior reflects a much broader concern. The combination of rising inflation, massive out-of-control government borrowing, and an ongoing war with no clear resolution in sight. Markets may not be panicking just yet, but they are absolutely adjusting. They are demanding higher yields as compensation for this increasing uncertainty. And that adjustment is going to cost the US government dearly. Now, to understand the government side of this equation, I need to share some numbers with you. Because the fiscal reality facing the United States right now is, to put it plainly, daunting. Over the next year, the next 12 months, roughly $10 trillion in US debt must be refinanced. $10 trillion. That is existing debt, already issued, coming due, that has to be rolled over into new debt at whatever rate the market is currently charging. Not the rate at which it was originally issued. The current rate. The rate that is being driven higher by exactly the dynamics we just discussed. Meanwhile, at this very moment, about 20% of federal tax revenue is already being used just to service existing debt. Let me repeat that. About 20% of federal tax revenue is being used as we speak to service our existing debt. 1 out of every $5 the government collects in taxes is not going to roads, not going to schools, not going to the military, not going to any program or service. It is going straight to bondholders as interest payments. 20%. And that number is rising, not falling. On top of that, add the war. Additional war-related spending, potentially reaching hundreds of billions of dollars, is piling onto an already overloaded budget. This is going to get really bad really fast. As you can tell from these numbers alone, as borrowing needs increase and demand softens, the cost of financing that debt rises further, creating what I can only describe as a compounding problem. A problem that feeds itself. A problem that does not naturally resolve. This is not a situation where you just wait it out and things return to normal. This is a structural deterioration that will require either dramatic policy changes or something breaking. And right now, I do not see the dramatic policy changes coming. This dynamic is being reinforced by growing volatility in the bond market. The key indicators that professional traders use to measure stability, to measure investor confidence in the Treasury market, those indicators are showing heightened instability. They are reflecting serious concern about 3 things: inflation, fiscal sustainability, and geopolitical risk. All 3 at the same time. In this environment, I would say investors are demanding, and rightfully so, a higher risk premium to hold US debt. What that means is that on top of whatever yield they would normally require, they are now asking for additional compensation just for the risk of being in this trade. And of course that pushes yields even higher. Of course it does. Compounding the issue, as if that was not enough, is a surge in overall debt supply. Not only is the United States government issuing more bonds, more debt, but corporations are as well. Total investment-grade debt issuance could reach as high as $14 trillion this year. Well, somebody has to buy it. So when supply increases faster than demand, prices fall and yields rise, which tightens financial conditions across the board. Everyone is affected by this. At the same time, the geopolitical backdrop remains highly uncertain. And that is, of course, to put it mildly. The Trump administration appears to be on track to put US boots on the ground in Iran. The population opposes it. But of course, that is not the point here. The Iran war has entered its 6th week with signs of potential expansion across the region. Additional troop deployments and ongoing attacks on Iranian infrastructure by the United States and Israel, to which Iran is retaliating in kind, suggest that the situation could persist for months or longer. Although, arguably, we do not have that much time, because by then, the global economy would be in a complete depression. My recent interview with economist Michael Hudson discusses that in great detail. I will link that interview in the description below as well. You are welcome to watch it next. So the longer the conflict continues, the more markets must account for sustained inflation, higher deficits, and prolonged instability. This does not look good for US Treasury auctions, as you can tell. The demand will continue to decline. Markets may not be panicking, depending on how you look at this, but they are definitely repositioning. They are becoming more defensive. They are requiring higher returns. And they are reacting very very quickly to new developments. This is very bad news for U.S. Treasuries. The demand for them continues to decline. Yields are climbing higher. Interest costs are climbing higher. And the global trust in U.S. institutions continues to decline. Needless to say, the key question going forward is whether tensions will ease or intensify. A de-escalation could stabilize yields and restore at least some confidence in Treasury markets. I say some confidence because the actions by the current administration have done more damage to the global faith in the United States and its institutions than any adversary ever could. That damage does not simply vanish because a ceasefire is declared. It has already altered the way foreign governments, central banks, and institutional investors think about U.S. debt. That recalibration is not easily reversed. It will take years to rebuild, if it can be rebuilt at all. However, a prolonged or expanding conflict, which appears to be what is next based on current trajectory, would reinforce all of these trends. Inflation stays elevated. Demand for government debt keeps weakening. Yields keep rising. Interest costs keep climbing. Financial stress keeps building across the system. At its core, this is a reminder of a fundamental truth. The bond market plays a decisive role in shaping economic outcomes, often operating quietly in the background. It ultimately determines the cost of borrowing for governments, for businesses, and for consumers alike. It does not make headlines. It does not go viral. But it is the most powerful pricing mechanism in the entire global financial system. And as recent events show, when the bond market starts to shift, it is a signal that broader changes may already be underway. Yields are rising. Demand is softening. The vicious cycle is in motion. The $10 trillion refinancing wall is coming. The war is in its 6th week with no exit in sight. And the trajectory, if nothing changes, points in one direction. Watch the space. Watch every auction, watch the yields, and make sure you are prepared for what comes next. Thank you very much for watching. I hope that you enjoyed this episode. Make sure that you follow me on X and on Patreon for more content. I would love to see you on those platforms. They will be linked in the description below. Have an amazing rest of your day. And as always, I look forward to seeing you right here tomorrow. Take care.